Do I look tired or rested? Don't answer that. You asked me about my portfolio, and that's what we're going to talk about today. Let's get into it. So, I'm Kiné Corder, the leading national certified counselor specializing in financial hypnotherapy for stress. And in my day job, I am building the world's largest global barber network that offers mental health and money systems. Because of that, I do talk about mental health, but money is the number one cause of stress, whether you have a little of it or a lot of it. So when it comes to mental health, what I talk about the most is stress. So my conversations aren't about mental illness, they're about mental wellness. And the way that I keep you well is to keep your stress down. Got a lot of tips in my Prosperous Barber Journal. Yes, I do focus on working with barbers, but this video, whether you're a barber or not, you're going to benefit from it. Let me tell you this. I said in a previous video, I think it was like, it's the one about being in a recession. That video, I said I was making some changes to my portfolio and I would share them with you if you wanted to. So somebody reached out and said, absolutely waiting on that video about your portfolio. Can you please drop it? And I am saying, yes, here we are. So, first, let me say this before I tell you any numbers. Do you remember me saying, I think it was last week, that I am okay sharing some information? Like, I am not necessarily a private person, but I'm definitely not the type of person that will sit on the bus or plane or wherever with you and just tell you all my business. Typically, people do that with me. I just listen. So I don't necessarily have to tell my business, but I am an open book if we are friends. Like if we are just more intimate, if we have a relationship, then I'm more open. But in these public places where I have no idea who's getting this information, I'm a little bit more private. I'm definitely not going to be intimate with you and give you intimate details, but I am going to give you enough information that you can do with you want with it. So the moral to what I am saying is there are limits. We are all entitled to our privacy. You are, I am. You're not sharing your numbers with me. I'm sharing mostly percentages with you, and some of the numbers. You are entitled to your privacy. So am I. There are limits to confidentiality because I'm saying I can tell you my business and then you can tell all the people. And this YouTube can tell all the people. So, because there are limits to confidentiality here, there are going to be limits to what I tell you. So, take this information. It is not advice, it's information. Take this information, do what you want with it. Feel free to ask more questions. But I needed to say that up front so that you know where our starting point is. I am saving for retirement. I am then that's what I'm talking about today. Maybe you have a what we call an accumulation account. Like this is outside of retirement. It is money that you're just accumulating wealth and it's taxable now, not deferred taxes. So if that is the case, this information that I'm giving you can apply to that if you want to take what I'm telling you and kind of do what you want with it, that information. Um, but I just need you to know that what I'm talking about specifically is a retirement account. So this account I don't need for 10 years. So the changes that I am making are based on my need. Why do I tell you that? Because your time horizon is going to determine what you do in any of your accounts. Every single one of your accounts should have a goal associated with it. And every single one of your goals should have a time horizon. So let's say you're saving, like in a savings account, let's just say for a home, and you could have that invested, or maybe you can have it in a CD or a money market account, and maybe it's getting somewhere. These days, you can get a good CD or even a good savings account for like four, sometimes on the higher side, like 4.75, I've seen. So you can get that and you can put your money in there. And that is a great way because, shoot, in a minute, you're not going to be getting 4.75 from even the stock market. You're going to be getting negative numbers from the stock market. So you might want to consider one of those little uh, conservative savings vehicles. So maybe that is you're saving for a short term purchase, like maybe you have 2 years and you'll need the money. So you do it in an instrument like that, or maybe you have not necessarily the goal is wealth. Like I am saving to get more wealth, and this could be a 5 year, a midterm goal, 7 year goal, and maybe you're doing that in what we call a taxable accumulation account, a taxable yeah account, not a retirement account. Why the name is just an investment account, a taxable investment account. And so that might be 5 to 10 years. That has a goal, that has a time horizon, and the way you invest in that account is going to be different than the way that you invest in your retirement account. Now, some of you have even longer time horizon. Maybe you have 20 years before you retire. Some of you have shorter. Maybe retirement is 2, 3 years away for you. You really need to be thinking about this recession and crash that are coming, because you have any day now. Because I've been saying 12 to 18 months for about 6 months. So maybe you have 6 more months. Maybe you don't. This could happen before Christmas. Now, I'll tell you that usually in the third year of an administration, they try to do something, the administration, they try to do something to rebound so that they can get reelected. Now, we know this administration technically is not supposed to get reelected. However, um, sometimes that still happens because the vice president might want to get reelected. And so they're going to do something in conjunction to help that vice president look good in front of the people. Now, in this case, it kind of seems like they're sort of divided and one is trying to separate themselves from the other. So if they are going to run in 2 years, then or start campaigning in a year or so, then you're looking at them as solo, as what they've done on their own, not what they did together. If that is the case, they're still going to need this third year to look good. And you might get lucky because of that. However, the reason why that might not work, the reason why that might not work this time, let's say that, is because we have so many events that there was a book and it coined the term like a black swan event, meaning there's so much inflated, like inflation is a problem. Interest rates can kind of be a problem right now. um, Real estate market is kind of a problem right now. Stocks, US stocks specifically, let's go there. US stocks are inflated, unbelievably inflated. And then you have things like SpaceX where they inflated it even more. And then you saw it drop. And I think maybe it's starting to climb back up. I don't know. But the reason why things like that happen is because the institutional investors, when I say institutional investors, I mean the big guys. And yeah, I mean guys, sorry guys, the big guys, they buy up a lot. And when I say big, I do mean the Morgan Stanleys, the Goldman Sachs, but there's these other money managers that you've never heard of that are also in there too. And then now you have VCs, these venture capitalists, and then you have hedge funds. And hedge funds are relatively new, considering like mutual funds, hedge funds. Mutual funds, I think, came first, and then hedge funds. Not sure, just they were right around each other. And this is within the last, like, let's say, maybe 50 years. And then ETFs came out. Maybe it's been about 20 years, I think. And so the ETFs are the exchange traded funds, which means that, exchanges like, they're trying to match like your NASDAQ and things like that, your stock exchange. So they are taking those indexes. And what an index is like a group of companies, a group of companies. They say, oh, these are the top, let's just say 50 um, companies. These are the top 30 companies. These are the top 500 companies, whatever that index is using to measure. And it's measuring what the stock market is doing based on these companies. So whether it is trying to mirror the S&P 500, right? The 500 companies, whether it's trying to mirror the Dow, maybe it's trying to mirror whatever it's trying to mirror. There are these fund managers, mutual fund managers that are also trying to do that. Now, aside from the mutual funds, like I said, ETFs came out. ETFs are a little bit cheaper than mutual funds. A lot of people started hating mutual funds because there are a lot of expenses inside mutual funds. And most of my 401k people, you probably have mutual funds in your 401k. I've never seen a 401k with individual stocks in it. Then maybe that's a new thing. If it is, I haven't been a stockbroker. It's been around 10 years. I haven't sold a stock in about 10 years. So I haven't, so maybe there are new, maybe there are new 401k instruments out there that do have individual stocks, but usually you have to buy that in your outside investment account in order to get to the individual stocks. Most of those are going to be ETFs and mutual funds. And that's why this is important to you. Now, to my people who have IRAs, like I have a 401k, but it's a solo 401k. And that solo 401k, I don't have a 401k provider. Like in your 401k, if you have a job, your company picks a provider, and that provider says, here's what you have available to you. And then you have to pick what they have available to you. Now, one of the things that happened about, I want to say like 30 years ago, is this like asset allocation fund. And so where you would just say 30 years from retirement, you click that button and then it would buy for you based on your asset allocation, based on your time horizon. So let's talk about asset allocation. Your asset allocation is different asset classes. Assets meaning, usually that means stocks or bonds, like stocks that I already talked about. Bonds, stocks meaning you own a piece of that company, right? Bonds meaning you lend that company some money and they're supposed to pay you back. That's what they're supposed to. And it doesn't have to be a company. Actually, I don't really like corporate bonds that much. Mostly you're looking at government bonds, like maybe it's a municipality or maybe it's a federal government bond. But that's another asset class. So stocks, bonds, inside stocks, though, let's break that down a little bit more. I know I'm supposed to be telling you about my portfolio, and I am going to get there, but I'm giving you this information because I wasn't even planning to, but it could be important to you. So if you look at stocks themselves, there are three versions. You have large cap, which is like your IBMs. They call those like the blue chip. Those blue chip stocks that pay dividends. So if you ever hear people say it, talking about their dividends, typically what you want to do is get those blue chip stocks like the Johnson and Johnsons of the world. They typically pay dividends. If they have profit, they pay their shareholders dividends. Those dividends can be reinvested, like you buy more stocks, or it can go into your cash account. And I like to, well, it depends. Sometimes I like to reinvest my dividends, but sometimes I like to send my dividends to cash so that I can buy later. If this company is one I just truly believe in, and I know it's going up, and I'm not going to be able to buy in later, then I am going to reinvest my dividends so I can be buying more rather than it going to cash, because by the time I try to buy them, they're going to be up. And you're supposed to be buying low and selling high. Now, those kinds of things you might not want to sell, but the more you reinvest your dividends, the more you're going to have. Now, why this is important, because that asset allocation I talked about, I'm going to get back to it in just a second. The more you buy of a certain asset class, the higher that asset allocation gets. Asset allocation meaning the percentage that is in each asset class. So let's go back. You have stocks. And in those stocks, remember I said you have large cap being those big companies, the ones that, and the tech companies are in there now, but it used to be back in the day that it would be More of the consumer product type companies like your Johnson and Johnsons, your Procter and Gamble, those people. And so Colgate Palmolive, and then you started getting like the IBMs and the even the Microsofts, and then the Apples and these new ones, the Metas and those people. So now the technology stocks are starting to be in there too, even though I don't know, they're a lot more risky to me. But these days they're holding the economy hostage. We'll talk about that in a whole nother video. Yeah, like that kind of too big to fail kind of thing, and that inflated, not inflation, but the price being inflated, meaning overpriced. And so next you have mid cap, and mid cap. A lot of times these are companies that you're familiar with. They're large enough to be publicly traded, but they're not competing with the Johnson and Johnsons. Um, so I don't know why, but none are popping up in my head. I can't even think of them because again, I haven't sold a mutual fund or stock and bond in a long time. I'm hoping that I should probably just hold this microphone because I want to make sure you hear every word. It is important. So we're halfway through. I didn't want this video to be 30 minutes long, but it might be. So you got your large cap, you got your mid cap stocks, then you have small cap stocks. I love small cap. I love small cap. It is a little bit risky. You have to do your research, but you can gain a lot quickly in a small cap because these are companies that are like up and coming. They call small cap, but they're not that small. They are growing. They're small, compared to a Procter and Gamble, but they're not small compared to your small business. They're quite large. So these small cap stocks are in growth mode, where uh, 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 a large cap stock it's just kind of stable. They're not growing. The like if you think about it, like Google now is probably a large cap, most likely a large cap stock. Google is not growing. They're not innovating. They're not doing anything new. You're not going to see this huge like la la la, aha hallelujah promenade moment from Google. They might buy a company that's innovative, but they're not going to create anything new, but the small cap stocks are doing that. So all of these are publicly traded companies that I'm talking about, not private. So that's your one asset class is your equities, large, mid-size, small. Then you have your bonds. This is where it's at. A lot of people don't like bonds because they're not that sexy, but the bonds are important because they're going to balance out your portfolio. Remember, the large cap stocks, they're large, they're stable. They might not be doing growth. You might just be holding your money steady. Right. The small cap might get you that growth that you're looking for. The bonds, they're going to get you that, but also dividends, more dividends. The bonds often pay a dividend. You loan them the money, and every single month they pay you a little bit back, a little bit back, a little bit back, a little bit back. And then eventually, some of the bonds, there is a payout date. Like, okay, now we're done. The thing that the bridge that we built and needed to pay off, we've paid it off kind of thing. And so that's one way that bonds work. Do your homework, do your research. This video is not a class, it's not a master class. This is not education, this is information. Let's remember that. So I'm giving you enough information so you know what you are working with. Maybe you can go back and look at your 401k stuff. Maybe you can go back and look at your IRA stuff. Because I know a lot of the people that I speak to, like my barbers, may not even have a retirement account. But if you do, it's more likely an IRA. It could be a SEP IRA, it could be a traditional IRA, it could even be a Roth IRA. Personally, I own a SEP. No. My partner owns a SEP. I have a traditional IRA, I have a Roth IRA, and I have a solo 401k. My partner has the solo 401k as well. And what we do in that account, because you can put more into it each year than you can an IRA. So the IRA has a cap as much you can put in. The traditional as well as the Roth have a cap as much as you can put in each year. The 401k you can put more in. So check into that. If you don't have a advisor, sometimes I like to recommend advisors that I know. Depends on the state you're in, whether they're licensed in your state. But sometimes I do have referrals, so you can ask me. I use Charles Schwab because we move around so much. We needed a place where our advisor, we needed a company where we could go anywhere. Morgan Stanley would be where I would go. However, you have a minimum of what you can invest in Charles Schwab. The minimums are a lot lower. In Morgan Stanley, the minimums are a million. I'm not there yet. The minimum. So most of their clients have way more than that. And I'm not even hitting their minimum. So most of the advisors are not going to talk to me. So that's why another reason why I chose Charles Schwab. But I chose Charles Schwab. However, I came from Morgan Stanley. My account was too small. And so I had to go to another company. I think it was TD Ameritrade, I think. Anyway, one of the other companies. And then it was bought. And then, yeah, it got traded because it was bought. Anyway, more information than you needed, but I was just telling you that does happen sometimes. So let's get back to our asset class and asset allocation so you can understand what I did with my portfolio. Now, for a while, I was heavy in crypto and that worked out for me. I put 15,000 in, I ended up going to 70,000, totally worked out for me. Then what I did in the last, and I wish I could tell you that I'm just this brilliant investor, but most of the time I'm just looking at the tea leaves. I'm just reading the tea leaves and I'm like, something's about to happen. And I just do what I'm supposed to do. So crypto went up. I knew this administration was crypto friendly. However, I still know crypto and I know that these people are trying to make money. And here's what they do when they're trying to make money. They screw you, the retail investor. And I was like, I'm not about to get screwed. So I'm out. I got what I got out of it. What was that? Like, three, four times what I put in. So I got what I needed to get out of it. Let me get out now. And I'm so glad I did that because right after I did that, crypto went down. So yay me. So I did that. I moved out of crypto. I went into heavy into stocks because I knew that that's another place where they were trying to get money. So crypto, they got their money out. Stocks, they got their money out. My portfolio was like 50% in stocks, and then the rest of it was allocated to different places. So it was 50% in stocks, and I even have a crypto ETF. I have two crypto ETFs, and I have crypto precious metals. So I'm sorry, ETF, a precious metal ETF. So 50% in stocks is too much now. So that scares me. So I've got to go and sell some things, but I can't sell all at once. And so what I'm looking at right now, how I make this decision is what is up. What is up? Where have I gained? That's what I'm looking at. And I want to sell some of that stuff. So you're like, well, why would you sell it if it's up? Because that's the fundamentals. Buy low, sell high. I'm not selling all of it. I'm just selling enough to take profit and I'm leaving some because if I believe in this company, let's say I own, I don't know, I'm just going to use easy number, 20 shares and I sold 10 of them or even 5 of them. I still have 15 to continue to grow and those 15 easily, if it's going to grow, can get back to the same value that it was at before I sold. Now, you don't really realize any gains or losses until you sell. You're just looking at numbers that could possibly happen. So when you own 20 shares, long, they call it, like you actually own it. You hear about long and short. Short meaning it's like a possibility. If it goes up, I have to buy it. If it goes down, I have to buy it because I said I think this stock is going to go up. And if it goes up, I'll buy it. So because you made that short sale, because you said that, you have to buy it. You put a contract out that says you have to buy that. You say, oh, I think this stock is going to go down. You're shorting the stock, it goes down. So this is a little bit, I'm trying to keep it simple. That gets a little bit complicated when it comes to, you might have heard the term calls and puts. So that gets a little bit more complicated. But when you hear the term shorting the stock, it basically means you don't own it unless it does the thing you said it was going to do. Then you got to exercise the contract. You have to buy it. I own all my stuff long. I don't do any shorting right now because you have to pay more attention than I actually do. I'm kind of a set it and forget it kind of girl. And so because of that, I'm an investor. I am not a trader. So my 50% stocks is just too much for me right now. Like I'm just seeing that again, reading the tea leaves, I'm seeing that some things are going to happen. So let me give you what I'm doing right now. I have my notes because there's no way I was going to remember this. Um, so equities, I'm going down to 25%. US equities, let me say that. US equities, 25%. And then, believe it or not, I really believe in international equities. So I'm about going to go about 15% into international equities. So that's everything except the US in this case. So that could be Japan, that could be even emerging markets. I'm all over the world. I see what's happening all over the world. And a lot of times these things don't happen around the world. Like if a US has a crash, the other ones lag. So you can benefit from getting over there, grabbing some money, and then getting out. Because it's an in and out kind of thing. Let me tell you this. Let me tell you this before I finish this portfolio. When is a sale bad? Do you like buying on sale? You buy everything else on sale. You would love to buy a car on sale, right? You love to buy shoes on sale, clothes on sale. You use coupons. You like sales. So why do you like spending high prices on stocks and bonds? Why do you buy when it's up? It makes no sense. Once they're talking about it on MSNBC or all the news channels, once they're talking about it on the internet, it's probably too late. Don't go buy it now because all the institutional money is already in there and they're going to pull their money out. The reason why, that's called advertising. They put it on the news channels because they want you to start buying it. They're advertising. You start buying and they're like, "Thank you, peace and I'm out." And they go out and then your stock drops and you can't sell it because you can't buy high and sell low. Duh. So buy on sale. Buy on sale. If you're not already in the market right now, this is only if you're already in the market. Probably should have said that in the beginning of this video. Who this is for, who this is not. This is if you're already in the market. Don't you go getting yourself in this market right now. When I told you the market is up, it's completely and totally inflated. It's coming down. Wait, put some cash on the sidelines and wait. Remember, this is just information, not not advice. Okay, let me hurry up. I got like 3 more minutes left. US equities, 25%. Equities outside of the US, 15%. Bonds, 25%, because that's going to protect my portfolio. That is that's this is just asset classes I'm giving you. Then I'm going to go precious metals about 10%. And my crypto ETFs about 10%. And then I'm going to have about 15% in cash. Now those numbers are not going to be that clean. Sometimes you might end up with 11% here instead of 10%. You might end up with 14% here instead of 15% because of the way the numbers go. Like how much does this stock cost right now? So this was a way to simplify what's going on, what's happening, how it's happening, what you should do if you are a bit afraid and you have money in the stock market, especially in your 401k, IRA, things like that, and you're retiring and you can't afford for a crash to take away your retirement. Now, like I said a few seconds ago, you really don't realize those gains until you sell. And a mistake a lot of people make is they bought the stock, it went up, they saw it go up, they were all excited. I had a client this happened to. She saw her portfolio go up to 900,000. She almost hit a million, 900,000. And then the stock market crashed and it took her portfolio down to 750,000. And she lost so much because she had so much in equities. Told her not to do that, but she did it anyway. So I did ask her because she was so close to retirement. So she ended up having to work a few more years. She did end up getting over that million. So yay for her. But she had to wait. But I told her this, she did listen to me. I said, look, your portfolio is down. What you own are good stocks. Do not make any changes right now because then you will realize those gains. These companies are coming back. Let them come back. And she did. So she let it come back. She ended up going over a million because 2011 was good. 2012 was good. So money start coming back into the stock market. So I only got 30 seconds left. I love you muchly. I will see you sooner. If you have questions, Let me know in the comments. Subscribe to this YouTube channel. Share this video with anybody you know who is wondering what to do, and let them know this is information, not advice. Love you much. See you sooner.